The financial catastrophe of 2008 had been building for years. A years-long spree driven by low-cost borrowing was ready for an accounting. In mid-2007, the British bank Northern Rock was on the verge of requesting emergency funding from the Bank of England. Two Bear Stearns hedge funds failed, and BNP Paribas was alerting investors that they might not be able to withdraw money from three of its funds. Reflections on Northern Rock, the bank run that heralded the global financial crisis. Bank for International Settlements. And that was only the start. Few investors realized that the world's financial system was about to be overtaken by the biggest crisis in almost 80 years, which would send the titans of Wall Street to their knees and usher in the Great Recession. Many common people lost their jobs, their life savings, their houses, or all three as a result of the 2008 financial crisis, which was a catastrophic financial and economic collapse. Sowing the seeds of the crisis. A house price bubble in the United States and other countries was driven by years of historically low interest rates and lax lending requirements, which laid the groundwork for the financial crisis. As usual, it started with good intentions. The Federal Reserve reduced the federal funds rate from 6.5% in May 2000 to 1% in June 2003 in response to the May 11th terrorist attacks, the dot-com bubble crash, and a slew of corporate accounting scandals. Making money accessible to consumers and businesses at discounted rates was intended to stimulate the economy. As a result of borrowers taking advantage of cheap mortgage rates to purchase homes, property values began to rise. It was possible to purchase homes, frequently at prices beyond their means, even for subprime borrowers with bad or no credit history. The subprime loan boom. Banks rarely keep the mortgages they provide, even during good times. Financial firms buy them back and sell them as interest-bearing assets. The large Wall Street banks purchased these loans from the banks during the housing bubble, repackaging and marketing them as low-risk financial products, including mortgage-backed securities and collateralized debt obligations, CDOs. Soon after, a sizable secondary market for creating and dispersing subprime loans emerged. This encouraged banks to take on more risk and allowed them to increase the leverage of their original investments by 30 or even 40 times. Signs of trouble. After a while, the housing market became saturated and interest rates began to climb. The federal funds rate hit 5.25% 2 years, after the Fed began hiking rates in June 2004 and stayed there until August 2007. Retrieved from U.S. housing market conditions, fourth quarter 2006. Many Americans suffered greatly as a result of this. The value of their houses was lower than what they had paid for them. They had to pay off their lenders before they could sell. Their expenses were increasing as the value of their homes decreased if they had adjustable rate mortgages. In June 2007, Bear Stearns halted redemptions in two of its hedge funds. The Bear Stearns moniker vanished in early March 2008 following the company's acquisition by JP Morgan Chase. August 2007, the dominoes start to fall. By August 2007, it was clear that the subprime crisis was beyond the financial market's ability to resolve, and that the issues it created were having an impact far beyond the boundaries of the United States. Fear of the unknown was a major factor in the complete freeze of the interbank market that keeps money moving across the world. In order to continue operating, Northern Rock had to apply for emergency capital from the Bank of England. The first big bank to reveal $3.4 billion in losses from subprime-related investments was Swiss bank UBS in October 2007. In the upcoming months, the Federal Reserve and other central banks would work together to lend billions of dollars to the world's credit markets. March 2008, the demise of Bear Stearns. By winter 2008, the U.S. economy had entered a deep recession. Global stock markets were plunging more than they had since the terrorist attacks of September 11, 2001. In March 2008, the global investment firm Bear Stearns, which had been a mainstay of Wall Street since 1923, failed and was bought for pennies on the dollar by J.P. Morgan Chase. September 2008, the fall of Lehman Brothers. By the summer of 2008, the financial sector was being ravaged. One of the biggest banks to ever fail in the United States was IndyMac Bank. The major U.S. indexes saw some of their largest losses ever in September, sending financial markets into a tailspin. It was difficult for the Fed, Treasury Department, White House, and Congress to come up with a coherent plan to halt the bleeding and rebuild economic confidence. The aftermath. The first week of October 2008 saw the approval of the Wall Street bailout plan. Among the many measures in the package were financial lifelines for Fannie Mae and Freddie Mac, a massive government purchase of toxic assets, and a substantial investment in bank stock shares. Following the ratification of the bailout agreement, the stock market stabilized after plunging to their lowest point in March 2009 and then experiencing the longest bull market in history. Which banks failed in 2008? The Federal Reserve of Cleveland reports that between 2008 and 2015, almost 500 U.S. banks collapsed, up from 25 in the previous 7 years. It's crucial to remember that no American bank depositor ever lost money as a result of a bank failure. The system was effective in that regard. Small regional banks made up the majority of the failing institutions. All of them, along with the accounts of their depositors, were purchased by other banks. Who made money in the 2008 financial crisis? A few astute investors profited from the crisis, primarily by selecting valuable items from the debris. Out of a combination of profit and patriotism, Warren Buffett invested billions in firms like General Electric and Goldman Sachs. When the U.S. housing market bubbled, hedge fund manager John Paulson made a lot of money betting against it. When the bubble burst, he made even more money betting on its recovery. Carl Icahn, an investor, demonstrated his ability to predict the market by purchasing and selling casino sites before, during, and following the crisis. The bottom line: the financial world is rife with bubbles. A stock's or any other commodity's price may rise above its inherent worth. Usually, the harm is restricted to the losses incurred by a few overly eager purchasers. But the 2007 to 2008 financial crisis was a different kind of bubble. If you enjoyed this story, don't forget to like, subscribe for more updates, and drop a comment with your thoughts below. We'd love to hear from you.